Welcome to the Business Scholarship Podcast, interdisciplinary conversations about new works in the broad world of business research. I'm your host, Andrew Jennings. If you like what you hear today, please consider subscribing to the podcast or sharing with others who might like it too. And if you have ideas for future episodes, let me know. My email address is andrew@andrewkjennings.com, and I look forward to hearing from you. Our guests today are Sehwa Kim, Assistant Professor of Accounting at Columbia Business School, and Seil Kim, Assistant Professor of Accountancy at Baruch College's Zicklin School of Business. We'll be discussing their recent paper, Fragmented Securities Regulation, Neglected Insider Trading in Standalone Banks, which I'll add a link to in the episode notes. Sehwa, Seil, welcome to the Business Scholarship Podcast.
All right, thanks for having me and having us. It's really great pleasure to explain our paper in your show.
So you've written an interesting paper, and it really jumped out at me because over the years, I've noticed every now and then that I'll look at an 8K or a 10K that instead of being filed with the Securities Exchange Commission, as we typically expect those types of documents to be filed, at the top of the document, it says filed with the Federal Deposit Insurance Corporation, which I've always kind of wondered what the story behind that is. And I was excited to see your paper because it answered that question pretty quickly. But could you describe why some companies file their securities disclosures on or with the SEC and why some file them with the FDIC?
So basically, here we use the term standalone bank to refer to a bank without a bank holding company. So basically, if the standalone banks, and then it is publicly traded, then they are exempt from SEC registration under the Securities Act of 1933. And therefore, they do not submit filings to the SEC through their ADGA system. Instead, they file with their federal bank regulator through FDIC Connect system, which is a separate filing and dissemination system created by federal bank regulators and administered by the FDIC. So to understand why this is the case, we need to go back to about several decades ago. So when the SEC was created in the early 1930s, banks were already heavily regulated and were presumed to provide adequate disclosure to their stakeholders, even if not obligated to do so by federal securities. So that's why they were exempt from the SEC regulation in the beginning. But however, several decades later, there was some debate on banks' disclosure practices because people found that banks were not making enough or thorough disclosure to their stakeholders. So the Securities Act Amendment of 1964 mandated SEC registration and disclosure for those firms with more than $100 million in asset or more than 500 shareholders. And this threshold, which applied to like a lot of these banks. So as a result, these banks were required to disclose the Securities Exchange Act filings such as like 10K, 8K, proxy statement to the federal bank regulators instead of the SEC because of the exemption from the SEC registration. And also later in 1974, there was another amendment was made. And then basically these banks, the standalone banks, the publicly traded banks, they are subject to the very, very similar filing by the SEC registration, but instead of to the SEC ADGAR, they report disclosure to their federal bank regulators. That's sort of the history.
That's such an interesting history that at one point banks were in the vanguard in terms of what they had to disclose, but at some point the regular company, public company disclosure requirements caught up and maybe exceeded what the banks had to disclose. And so there was this harmonization between the disclosures, but you still have this dual track system where a standalone bank is filing these securities disclosures with the regulators instead of with the SEC, whereas a bank that has a bank holding company, and I guess most of the large ones do, Bank of America, Wells Fargo, JP Morgan Chase, they have a bank holding company and they file with the SEC, whereas I think in the paper you mentioned a few larger banks are still or are currently standalone banks, for example, Zions, Bancorp. Kind of to think about the the ecosystem a little bit. What sorts of banks typically are standalone banks, and is there movement back and forth between this FDIC securities disclosure system and the SEC's Edgar disclosure system?
This is Seil. So historically, the smaller banks would be the standalone banks because if you were to engage in brokerage businesses or investment banking, then you would have to put those other businesses under the bank holding company umbrella. But standalone banks can only operate as commercial banks. So these would historically be smaller banks. But over time, the difference between a standalone bank and the bank holding company, the difference became smaller. And so now there's various large banks and small banks that are operating as standalone banks. And also, even within bank holding companies, there are bank holding companies that only operate one commercial bank instead of having a variety of businesses. So right now, I would say that the difference is rather small.
And you mentioned that there's a little bit of a recent story of some larger banks that have, or banks that have a bank holding company, but only that one bank within the umbrella have been shedding their bank holding companies and becoming standalone banks so as to avoid maybe an extra layer of regulation or several extra layers of prudential regulation.
Right. So standalone banks, because they're just commercial banks, they don't have this extra layer of regulation that are enforced on bank holding companies from the Federal Reserve. And recent regulations from Dodd-Frank or Basel III, they were the bank holding companies were subject to those new regulations, but the standalone bank structure was not. So there were certain banks like Zions Bancorp or Bank of the Ozarks and Bank Court South. These banks wanted to avoid those extra regulations, so they shed their holding company and reorganized into one commercial bank, a standalone bank.
So we've got this interesting dual securities disclosure system, at least for some types of companies. Conceptually, what are some of the problems this could pose from a capital markets perspective? And what has the literature said about that point up to this point where you're building from?
So this is Sehwa. So basically, as you mentioned, like this financial regulatory structure in the U.S. is very, very complex, consisting of multiple agencies with overlapping responsibilities. So the regulators or many other parties have raised concerns that this regulatory fragmentation may undermine the stability and efficiency of the U.S. financial system. So historically, many academic studies actually examine the consequences of fragmented regulation, but mostly focusing on the effect of the regulator side. So some regulators are more strict, like some are more lenient. These studies were very influential and very important studies. But however, we believe that fragmentation regulation can also have effect on the financial system through many other channels. But still, we have very limited evidence on this effect. So basically, our paper trying to capture some different aspects of the fragmented regulation, more focusing on the separate disclosure system, because it may increase the information asymmetry between filers and investors, or also it can increase the cost of searching those filed documents on that system, and then may have some negative impact on capital market. Especially those insider trading forms should be like relatively very straightforward and simple information content, and it should be their impact on price should be reflected on the market very, very quickly. However, if investors have some difficulty to find those filings when it is made, and then how they incorporate those information into the market price, we choose some inefficiency in terms of the stock market efficiency. So we try to suggest the empirical evidence that those insider filings made on the separate system, FDIC Connect, is actually subject to the lower market awareness and higher searching costs, and does have some negative impact in terms of the stock market efficiency. That's what we're trying to say in the paper.
So we have this potential issue of When an insider files his or her Form 4 stating that securities have been bought or sold, that's valuable information for the market, and we expect the market to react to that information because it presumably says something about the insider's perspective on the company's prospects. But you point out that there could be informational asymmetries, there could be extra searching costs between disclosing on one system, which is very closely scrutinized, and that's the Edgar system, and this other system that's smaller that has fewer eyes on it, and that's the FDIC system. And so you have an opportunity there to explore the idea of a fragmented disclosure system and looking at the difference in market reactions to these Form 4s between the two systems. How did you design that study? How did you set it up?
So this is Sehwa. So basically, we think that the main empirical challenge for isolating the effects coming from this separate disclosure system on the stock price efficiency would be like these standalone banks and bank holding companies are quite different in many aspects. So this raises concerns that our findings about the short-term reaction to this insider trading filings may not be driven by the separate disclosure venues per se, but rather may be driven by some underlying bank characteristics such as like size, business model, the organizational structure, etc. So to address this concern, we use three different empirical strategies. First, we do the matched sample analysis. So basically, we match standalone banks to bank holding companies consisting of only one commercial bank with a similar bank characteristic in terms of size, capital ratio, and balance sheet composition. So in this way, we can minimize differences in bank characteristics as well as the organizational structure between treatment banks and control banks. And second, we do the within bank analysis by limiting the sample to banks that were once changed its organizational structure from a standalone bank to a bank holding company, or vice versa. So in this way, everything is compared within the same bank, and then hoping to control like some time invariant bank characteristics, which may drive the stock market outcome. And finally, we run a placebo test using earnings announcement. So whereas insider trading is disclosed first via Form 4 filings at the disclosure system, in most cases, earnings are announced in press releases first. So if the market differently reacts to earnings announcement by standalone banks and bank holding companies, it may be driven by some unobservable bank characteristics. But however, we do not find any differences in market reaction to earnings announcement, unlike we find a stark short-term difference for the market reaction to the insider trading filings. So based on all these designs and the empirical evidence sort of direct us that maybe the different short-term reaction to insider filing forms is driven by the separate disclosure system.
What might be some of the mechanisms of the difference in short-term reactions being driven by that separate disclosure system?
This is Sehwa. So basically, we looked at several potential mechanisms driving this difference in the short-term reaction, including media coverage or the role of sophisticated market participants such as like equity analysts and institutional investors. So basically, we found that the media coverage for the filings on FDIC Connect is much less than those filings on SEC Edgar. And also, we found that number of analysts following standalone banks and institutional ownership for the same banks are smaller than bank holding companies. However, when we try to isolate the single factors like one by one, we could not find strong evidence that this only single factors alone drive the short-term market difference. So basically, we believe that the generally lower market awareness about the FDIC Connect and higher search costs for filings on the FDIC Connect, which are generated or created by different information environment, sort of altogether drive our findings.
And how did you you had some tests in your paper for some of these mechanisms. How did you test those, and what did you you find that might have supported these mechanisms being at work in explaining the difference in short-term reaction to Form 4 filings between the FDIC system filers and the SEC Edgar system filers?
So basically for this Sehwa, so basically for the media coverage, we just find that there is like thousands news wires which sort of provide the real-time information to many market participants. There's not a single the thousands news wires covering for this insider filings made on FDIC Connect. So this is like I think we believe like very, very important difference between the FDIC Connect and SEC Edgar.
It seems, and I think your paper does a nice job of kind of showing some of the potential asymmetries and higher searching costs associated with this fragmented securities disclosure system. How should we think about these results in terms of regulatory policy, or how should the financial markets be interpreting or looking at or thinking about this issue?
This is Seil. So we're academics and not regulators, so I guess we're a bit limited on what we can say about what the best optimal regulation would be. But so what we think is that the banks and the bank holding companies, the content of the disclosures are sufficiently similar. The current system of having each federal bank regulator to have staff to receive periodic filings of a few banks may be inefficient. But trying to solve this from the investor side is also costly because an investor would have to track both the SEC Edgar system and the FDIC Connect system if they want real-time information from the companies. So one of the things that regulators could do is increase market awareness and reduce the search costs by letting more investors know about the separate disclosure system that applies to standalone banks.
It seems like almost it could be, a technical fix where if some of the wires and some of the services that aggregate financial information just incorporate a feed from FDIC Connect into the same feed that they use for Edgar. Has the banking industry weighed in on this issue, or have they expressed any thoughts or views on how to improve it?
For the best we know, we haven't really found any discussion about how to address this issue. One interesting example is Zions Bancorp, which is a big bank holding company that recently shed their holding company structure because they wanted to avoid certain regulations applied to bank holding companies. And uniquely, this bank is still filing on the SEC Edgar system as a voluntary filer, quote unquote voluntary filer.
So there is that opportunity if I'm a large bank and I want to make sure I have ample analyst coverage and ample eyeballs from the markets, that I can continue to file these things on Edgar, knowing that will at least get attention, even if there isn't as much focus on filings with the FDIC Connect system. So there's a little bit maybe of a private ordering solution there as well.
Right. So, but still, Zions Bancorp in its filings mentioned this might not be a permanent thing that they file with the SEC. So I'm not sure how good of a fix this would being a voluntary filer would be.
Sure. I guess that's kind of a wait and see. So this paper has looked really closely at the issue of insider trading and its effect on share prices through the vehicle of the Form 4 filing. What limitations does your paper have, and what future avenues for research does this paper open up?
So this is Sehwa. So basically, our study only speaks about like one potential cost of having the separate disclosure system for this certain standalone banks. But we cannot speak about some potential benefit of having the separate system for these banks. So we want to be careful about that point. And also, there could be a lot of different potential costs of having the separate disclosure system. For example, there might be some the differences in terms of quality of disclosure made by these banks on separate system, because like they may delay the timing of the disclosure system, or they may limit the content of the disclosure itself. So we're not sure about like how they are different in terms of these aspects. So we hope to see more research regarding this issue, so people are more aware about the existence of FDIC Connect, as well as some benefit and cost of having the system separately.
Our guests today have been Sehwa Kim, Assistant Professor of Accounting at Columbia Business School, and Seil Kim, Assistant Professor of Accountancy at Baruch College's Zicklin School of Business. We've discussed their paper, Fragmented Securities Regulation, Neglected Insider Trading in Standalone Banks, which I will include a link to in the show notes of today's episode. Sehwa, Seil, thank you for joining the Business Scholarship Podcast.
Thank you for having us.
Thanks for having us.